Hey guys, Marcel LeBlanc here, Certified Financial Planner. And today I'd like to illustrate how the different kinds of investment returns or investment incomes that you can generate affect how you're going to be taxed on these and what kind of effect that has in your overall investment plan. Now before I get into this, I want to mention that here I'm not necessarily talking about RRSPs or tax-free savings accounts, because the RRSP and the TFSA are already tax sheltered or tax deferred plans. So the kind of tax that you would be paid on these investments don't really matter at the end of the day. So if you have to invest outside of a TFSA or an RRSP, in the case of investing within your own company, or if you've maxed out both of these plans, you have to invest in something called an open or non-registered account, which means that you're fully exposed to being taxed on your returns. Now, there's three kinds of investment incomes you can generate. The best kinds are capital gains. Capital gains is buying something for $100, selling it for $200, you've made $100 of gains. The reason it's the best one is because you're only taxed on half of your gain in any kind of context, pretty much. So you're only taxed on the $50 out of the whole $100 gains. The worst kind is interest. Interest, like in your savings account or GICs at the bank, are taxed at the same rate as your salary. So all interest income is just tacked on top of your existing salary, which means that if you're somewhere in the $40-some thousand or more range, you're losing a third of your interest in your investments to tax every year. Dividends you're getting by investing in companies, either through the stock markets or private companies. You can get paid a dividend, and you get a tax credit for that, which makes it fall somewhere in between the capital gains and interest. So why is that so important to you or your investment plan? Well, let's put it this way. If you're paying 34% tax on your interest returns, let's say, and you have $10,000 worth of interest paid to you every year, and you have to give $3,400 of that away, you only get to reinvest the difference. So $6,600, and so on every single year. Versus if it's a capital gain, you only have to pay $1,700 in taxes to keep more of your own money and reinvest it the next year. So if you have any questions regarding this or any other financial question, reach me at marcelleblanc.ca, and remember that my advice is free and always will be.